The problems with the underwater mortgages is that it becomes difficult to refinance your house if you decide that you want to refinance your house. It can become difficult to sell your home, and there's a very high potential for foreclosure on your house. Hi, this is Anita from Real Estate Crunch. Today we're going to talk about something which a lot of people may be experiencing or could be experiencing in some parts of the United States. It's about an underwater real estate mortgage. And this happens a lot in areas in the United States where housing prices are going up to a huge amount, and maybe you buy your house high and then all of a sudden the housing market starts to drop again, and you find that you owe more to the bank or to the mortgage than what you're able to get out of your house. So we're going to talk a little bit today about what an underwater mortgage means and why it can be dangerous and why this can really hurt you. An underwater mortgage is also sometimes called an upside down mortgage. It's when you owe the bank more on your real estate property than what the property's worth. Having an underwater mortgage can be a problem for property owners, especially if they want to sell or refinance a property. Underwater mortgages happen when you purchase your home when the housing prices are high, and then the economy or the property market takes a dive, and now your home or property is worth less than what you owe the bank for your mortgage. So let's say, for example, that you purchase a home for $300,000 US dollars. The bank comes in at the time you're buying it, and they value the home, and they say your property is worth $300,000. You put $40,000 down, and the bank gives you $260,000 for the loan. A few years later, that you notice that your neighbors are having problems selling their homes for $300,000, and they have to lower their prices. So since you purchased your home, the housing values have been increasingly falling, and the economy's dived, and interest rates have gone up. And so all of these things have happened. So suddenly there's fewer buyers out in the marketplace. And thanks to the decrease in the market and the drop in the housing, your home is now assessed to be worth $200,000 US dollars, but you still owe $230,000 to the bank. And also, you should note here that you put $40,000 US dollars down. So actually, you've lost. You're right now, about $70,000 at least. So we would say at this point that your mortgage was underwater, because it means that you now owe more for your property than what your property is actually worth. That is what an underwater mortgage means. So you can, that's the main reason why a lot of people get underwater mortgages. Another reason could be that maybe they begin to miss mortgage payments. And as they begin to miss their mortgage payments, these mortgage payments begin to accrue and to add up. And then eventually they find that they're getting underwater in their mortgage because now they're not paying off the principal of their house. They're just paying off the interest of their house. The problems with the underwater mortgages is that it can become difficult to refinance your house if you decide that you want to refinance your house. It can become difficult to sell your home, and there's a very high potential for foreclosure on your house. That is why an underwater mortgage can be so dangerous or so difficult for you if you have an underwater mortgage. That is also why this is a problem and something for you to understand. A lot of people, when they buy property or they buy real property, they sort of have this feeling that no matter what, the property is going to go up. But the truth is that property can go up and as well as it can go down. And so that's why if you buy high, you may find that you're actually, you're buying high and you actually end up with an underwater mortgage because you bought too high and the value will go down. There's a lot of people that believe now in the United States, and I'm one that also believes in especially some parts of the United States where there has to be a correction. I was talking to a woman the other day, and she said that her house was valued a couple of years ago at $300,000. They just got it revalued and it's $700,000. That's crazy for that type of increase for the same type of house, especially when people's income has not gone up. So it's going to have to go down. There's going to be a correction. So if you buy that house for suddenly now 700,000, you'll probably end up with an underwater mortgage. So if you'd like to read more about this and what is an underwater mortgage and what exactly does it mean, we'll put a link below to our blog so you can read it on our website, Real Estate Crunch. We appreciate you being part of our community, and we hope that you learn something with us 5 minutes each week as we go through different things about real estate. We'd love to hear from you if you have any questions. And we want to thank our team who helps put this together, especially Rico, who helps put together all of our podcasts. Thank you so much for being part of our community.